Hey, this is Jordan. This video is being recorded on the morning of Thursday, May 16th, 2024. Thank you so much for tuning in. In this video, just have one chart to go through, and this is my big picture historical macro market chart with, of course, a focus on precious metals, and I've included the S&P 500, as always, and the bond market. And that leads me to opine a bit on where we are as far as the best macro market comparison. And it really comes down to, are we in the mid or slightly late 1960s, or are we in the early 1970s? So let's get right into it. Okay, so only one chart for you in this video. So we have the stock market here. This is bonds divided by the CPI. The reason I do that is because it helps us see the secular bears much more easily than if it were in nominal terms. This is the Barron's Gold Mining Index, silver, gold, and then this is the CPI, the Consumer Price Index. So I'll try and go one by one here. So this is the stock market. This moving average is the weekly equivalent to the 40-month moving average. And if you've seen my other videos, so that I like using this moving average as a demarcation point or line for secular trends. If we can see here, let's go back here. So this was the start of the secular bear at the end of 1968. We can see that mostly through here, the stock market held above the 40-month moving average. It went below it a couple tiny bit here, a little bit here, but it fully lost it here. Then the secular bull started in 1982, and we can see here, look, it held above the 40-month virtually the entire time. Then it lost it, I think, 2001. So, of course, secular bottom here, secular bull, and it's holding above the 40-month moving average. Now, the COVID crash for a month or two, I think it closed below it, but it's been testing it, but is held above it. So we're still in a secular bull for the S&P, and for a variety of reasons, I think this is the best comp for the S&P. I mean, we're somewhere, are we in 65, 66? There also is a chance we could be right here based on the other things that are happening. We could be in 71, possibly. That's where we are with the stock market. We're definitely in the latter stages of the secular bull market. Is it going to last another year, 2 years? Maybe, but nobody can argue we're in the later stages. Okay, so let's get to the bond market. Again, total return of bonds, so the total return of the 10-year bond divided by the CPI. Secular bear started here. Secular bear started here. 1965, of course, this was a secular bull. 82, we can see all the way to COVID. Based on my analysis, again, the secular bear started in 65. And this is when, I've talked about this in other videos, when long-term interest rates, such as the 10-year bond yield, started rising. And so they started rising at this point, and that caused a lot of problems. It led to the end of secular bull in stocks. So very important to include bonds. Maybe bonds can make a case that we're in the early 70s because we've already seen 3+ years of losses here, which would, that would be similar to this right here. It'd be similar to this. And maybe we could get a bit of a counter trend move. But anyway, so that's bonds from a macro standpoint. We're in a new secular bear for bonds. That's not really debatable. Okay, gold stocks, Barron's Gold Mining Index. So this is the key right here. Huge breakout, 28-year breakout, and then they exploded from 64 to 68. Now, the best comp for this is gold's breakout here and now. And that's because the gold price, we were on the gold standard until 1971. And I've mentioned this in other videos. If gold were freely traded back in the day, generations ago, it would have broken out in 1964, 65, because that's when inflation started to move. So that's the gold stocks again. The key thing here, the best comparison to this is this breakout in gold. So that would make the argument that we're in 64 or 65. Next, silver. So silver back then, just a really tiny, obscure market, really not that important. Don't get mad at me, silver bugs. So silver is getting ready to launch. It's in the process of breaking out from here. It's already done so in weekly terms, did it in daily terms yesterday. So this is getting ready to launch a little bit. It should be able to get to the mid 30s, as I noted, pretty easily. But this could, if it really picks up, 50 is not out of the question in the next 12, 18 months. So you could say, well, that's similar to this, or it's similar to this. Based on the degree of the move that silver could make, I think this comparison here, the early 70s, is a better comparison. And another reason for that is because you had this bear market, the cyclical bear in silver, which was not super severe, but fairly severe. So you had this cyclical bear in silver for 3.5 years. This was 3.5 years here. So silver lines up, I think, better with early 70s. Okay, now let's talk about gold, which is really hard to do because we can't compare it to this time here because we were on the gold standard. Of course, you have this huge breakout, 13-year cup and handle pattern, the biggest breakout in gold, obviously, since right here, which was artificial, but this is a bigger breakout all the way back to this point. And so historically, it's hard to say, again, comparing it to gold stocks, this is the best comp, but as far as the move that gold is getting ready to make, I think it could be right about here, potentially. So for gold, I would say early 70s. Now, finally, this is the CPI. I should have put this in log format because when you're looking at, this is like 100 years of data, it's really hard to even see the moves here. So I apologize for that. But right now we're seeing statistical inflation. So I call it statistical inflation. So statistical inflation, the direction of inflation. Of course, it exploded after COVID. It came down just naturally because of statistics and comparisons. Now it's starting to turn up again. So that's something that also could put us in the early 70s because at this point in the mid to late 60s, inflation had already broken out. I mean, again, I apologize. It's hard to see it here, but the rate of inflation had already broken out here. And here it came down right here. So this is something that I would say compares more to the early 70s than the late 60s. Okay, so my final comments would be whether this is the mid to late 60s or the early 70s, it doesn't mean that the market is going to repeat or duplicate that exactly. We're just getting a sense of how all these things moved historically, the past relationship, and maybe it can help us anticipate and project performance going forward. With that said, in the past, I was more thinking this was mid to late 60, and it still may be. I mean, this is subjective. This is not super objective analysis. But my opinion would be, I think we're lining up more with the early 70s now. And everything is not going to be a perfect comparison, but given just where we are in precious metals, I think the early 70s is a better comp. In the stock market, it kind of made a bit of a higher high here. So in the early 70s, that move in precious metals, it started with precious metals going up with the stock market. And then we got into that negative correlation where for that 18-month, 2-year period, we had the bear market, the S&P, and precious metals exploded. So I think the early 70s is the better comp at this point. Let me know what you think. Leave a comment. Thank you so much for tuning in. I'll talk to you guys again in the next video.